Hello everybody and welcome to Automate with Jonathan. In this video I'm going to take a little different approach here and walk you guys through a spreadsheet I made that analyzes a scenario of owning a house and renting it out. It's just a little change of pace for the content that I make here. So little first disclaimer, this is not financial advice. There could be mistakes in this. And also many assumptions, if not all the assumptions can change. All the assumptions can change. And when I talk about assumptions, I'm talking about rental management fees. I'm talking about upkeep. I'm talking about your tax rates of the property and everything. So I make a bunch of assumptions. This really only makes sense in the context of those assumptions. So let's look at our assumptions here, which everything's kind of laid out here. And then I have a 360 payment schedule of cash flows and payments. It's pretty nifty. It starts at year 0 and ends at year 30. Well, year 29, right? But that's actually the 30th year because we started at 0. Counts the months. I was testing one. So let's analyze a $400,000 house, and the purchase price minus the down payment is going to be $360,000. So it's a $40,000 down payment. So in month 1, there's going to be $1,500 of interest, a $432 principal payment for a combined principal and interest payment of $1,932. The property value is going to remain constant throughout the year. That's just the assumption of this formula or spreadsheet, whatever. And the taxes are going to be 2%, divided by 12 months. So $6,000, $6,100, something like that. We're going to assume a monthly upkeep cost of $100. I don't know if that's 100% accurate. It might change depending where you are. And then there's going to be a approximate rental amount. All right, so let's. Yes, it's $2,500. This needs to get updated here. Let me update this here. That was just a hard number in there. We need to make that C12 and then press F4, and then we need to drag this through. Nothing should change here. Oops, that's not going down. Oh, we can do it this way. Yep, nothing changes. So in this scenario, we assume that the home is appreciating at 5%, whether that reflects reality or not, who knows? I'm just playing around with numbers here. We've assumed that we put a $40,000 down payment, that the insurance and taxes are going to be, or at least no, that's just taxes, right? Yeah, taxes and insurance. See, that wasn't factored in there. So where is insurance? No, I don't put insurance in there, so we have to put insurance in there. We can just make this insurance monthly, and it's going to be something like on a $400,000 home. I mean, I would say annually. I don't even know, like 0.075% of the property value annually, so monthly insurance is going to be, right, we want to do it off of the asset value. All right, monthly insurance off the asset value. It's going to be this divided by 12. Right, and you have to put the F4. Yeah, about $250 a month. Could be higher, could be lower. Right, so okay, so that's the $250 per month. Monthly upkeep $100. Monthly mortgage payment, principal and interest. Principal and interest is really, we should put this in here, that payment formula. Purchase price $400,000. Mortgage interest rate 5%. Monthly mortgage interest rate, just that divided by 12. Number of payments, number of years, tax rate 2% annually. What you could rent it for. Right, so here's the beauty is that where this really shines, rather, I don't know if you can make money from it or what, but is that this home rental price started $2,500. Where is that? Is right here. But the beautiful thing is that your rental price can grow, right? So we have a growth factor of 6%. Right, so applying that 6% monthly rental price growth factor, what we can do is this payment here. Over the years, in 10 years and 120 payments, is it unreasonable to think that in the year 2033 that this home could be renting for $4,400 a month? I don't know if that's unreasonable. I don't know where interest rates will be or whatever it might be. I don't know what happens. It's a good question. It's an unknown, who knows? But in the first year, in this scenario, renting at $2,500 per month, we're going to be losing $200 per month in cash flow. Oh, you know what? More than that. Because we forgot to factor in the insurance that we just added in there. Right, negative $450 a month, basically until year 5. And in year 5, the cash flows begin to break even. However, in year 5, after 60 payments, we've now paid that house down to $330,000, but the asset itself is worth. Where is it? Where's the property value? Right here, column H, is worth 510. Right, so there's 100. So after we break even after 6 years, however, we've generated $180,000 of equity potentially, in this formula. Right, let's look at year 10. In year 10, we're cash flowing out of the property $872 a month. The property is now worth $650,000, and we owe under $300,000. It's a beautiful thing. So when you have a rental, when you have the rental growing faster than than the monthly upkeep costs, it's you're going to see the value diverge, right? So let's say our rental price could only grow at 2%. 2%. What happens if at 2%, that means in year 2 we're only charging $25.50 for it, whereas before we were charging $26.50. Right? So at 0.02, we don't break even. Ever, actually. Our cash flows are never positive if we can't grow the rental price, right? Yeah. So the upkeep really has to be over. This really doesn't make sense unless you have positive growth. I mean, and this is why they keep the money supply growing, because when these numbers get too low, when the divisor gets too low, the numbers don't make sense anymore, right? So this is a pretty prime example of why prices going up, it's built into the system. There's no way of getting out of it. Either prices go up, or they got to find a way to get prices costs down, like drastically. I don't know how they're going to do that. Maybe flood the labor supply. I don't know. The jury's out on how that could be done. But yeah, this is a nice little spreadsheet here. And if you guys are interested in this is by no means complete. This is just me playing around with numbers. And you can kind of look at your own, make your own whatchamacallits, figures and interfaces, right? So it's like, oh wow, this property cash flowed me, cost how much over for all the upkeep, at 0.04%. For all this time, it was $57,000. This doesn't get all the costs in there, please don't hold me to this. Not perfect. But yeah. But like what happens if there's 0.09? What if there's 12% rental growth rates? You break even in year 2. And 30 years from now, when I'm freaking 64, this property could be flowing $58,000 a month. 58 grand a month, that's crazy. I mean, what would money even be at that point, right? If one house can flow $58,000, but that's what at the current rental price, growth rate. So yeah, if you like this video, hit the like button. Please subscribe. If you want this spreadsheet, leave me a comment below and ask for it, and I'll send it to you. Thank you so much. Bye-bye.